If you're a UK director that's in financial distress and your business is struggling, you've probably got a million questions. But in today's video, I'm going to share with you the top 6 questions that I get asked and my team get asked on an almost daily basis. So I'm not just going to share the questions with you. Stick around to the end. I'm going to share with you in-depth answers that I hope will answer you and put you in a better position to make better decisions. Chris Worden, director first. Here is question number 1. What is the cost of liquidation? Okay, so to liquidate a standard company in the UK, so you may have, a handful of suppliers, you might have a bounce back loan, you might owe HMRC some, you're looking at around 5 grand plus VAT at the lower end, okay, up to maybe £10,000 plus VAT, depending on who you work with. We're generally charging sort of £5,000, £6,000, £7,000 plus VAT to liquidate a small business, okay? The thing that you've got to be mindful of, right, is that is not the question you really should be asking, okay? It's an important question, what does it cost to liquidate? But a more important question for you is, what is this going to cost me? Because there are additional costs that you may not be aware of that come from placing a business into liquidation. And I'm going to get into those costs on a question that I get asked a little bit later on. So please be aware, if you want to put a business into liquidation, let's say you're going to be charged £5,000, £6,000, £7,000 plus VAT, but it's highly likely that is not the whole cost that it's going to cost you. There are hidden extras that you may be expected to pay, and I'm going to come to that. So, second question is, how can I pay for the liquidation fees? So, generally speaking, if you've got money in the business account, you can use that to pay the cost of liquidation, okay? Now remember, the money that you've got in your business account, it doesn't belong to you, it belongs to the company, and actually it's creditors' money at this stage. It's worth saying, once you've become insolvent, so you can't pay your debts when they fall due, or your liabilities are more than your assets and there's no hope of recovery, you've got to be really careful what you spend that money in the bank on. But one of the things that you can spend it on is an insolvency practitioner's fees, okay? If there is no money in the bank, you may be asked to pay for the fees personally, okay? Now, sometimes you might have, I don't know, 3 or 4 grand in the bank and you might have to top the fees up personally. So if there's no money in the business, you may be expected to pay the insolvency practitioner's fees. Another way that an insolvency practitioner can be paid is potentially, let's say you're buying some assets from the business. I'll give you an example. There is a vehicle that is worth £15,000. In some scenarios, if there's no cash in the business, you have no ability to pay the liquidation costs, the insolvency practitioner, when you pay the £15,000 for the van, they can take their fees from the asset purchase, okay? In addition, let's say, I'm going to come on to this, let's say you are settling some type of claim against you. Might be an overdrawn director's loan. I'm going to come on to that in a minute. But an insolvency practitioner can take their fees from any realisations that they make off the director. So, now, this is important. If someone's saying that they're going to put you into liquidation for nothing, or they will charge you 2 grand or 1,000, or they say don't worry about that, you've got to be really wary, because they're definitely going to get paid, and if they're doing it cheaply, the chances are you're going to be getting hit with fees that you might not know about. because they're definitely going to get paid for the work that they do. Again, I'm going to come on to that a little bit later in this video. Another question that we get very regularly is, how long will this take? Let me have a little glass. So, the question of how long will it take is dependent on what it is you're having done. So, let's say that you're going into liquidation, the business has become insolvent, and you want to put a formal end to the company. You can have a business in liquidation, it's generally 14 to 28 days because you have to give your creditors notice of the pending liquidation and the creditors meeting, okay? Now, it sometimes can take longer because once you've made the decision that you're going into liquidation, the insolvency practitioner needs a raft of information from you. They need to pass you through anti-money laundering checks, they need details on the company, a list of creditors, filed accounts, etc., balance sheet, information on assets, information on staff. So those that who are super organised can have that done in a day. I've seen some directors take weeks and weeks and weeks, and an insolvency practitioner cannot give you your notices to sign until they've got all the information they need off you. What we do here at Director First, by the way, is we'll send you a shopping list of the information we're going to need before the insolvency practitioner can issue your notices. But in the shortest time scale, they can be in liquidation in 14 days. Now, if it's an administration that you are considering doing, administration is very quick. Again, there's going to be some information collection that's needed pre-appointment, but whereas in liquidation you have to serve notice on the creditors to tell them it's going to happen, in administration you file a document, the insolvency practitioner files a document in court on the court's e-filing system, and you're in administration that day. So it's done like that, very, very quick. Now, some of you might be thinking, well, I like the idea of what this pre-pack administration has been mentioned to me. And there's a bit of a longer time period with a pre-pack administration because you have to have the business valued, you have to have an evaluator's report, and the business needs to be marketed on the open market. So in them scenarios, you're probably looking at around 2 weeks before you get the business into administration. A CVA, a company voluntary arrangement, is where you put together a proposal with an insolvency practitioner to show your creditors that you're going to be able to pay them back over an extended period of time. And this proposal is quite a weighty document. So I would expect that's going to take at least a couple of weeks, maybe up to a month, in some cases longer, before that draft proposal can be circulated to creditors. You may be wondering, how long does it take to dissolve a company off Companies House? Let's say you have no debts and you just want to strike the company off, or you've seen my videos, if you may owe the HMRC a little bit of money and you have no way of paying them, the business has been deregistered for VAT, it's no longer been trading, it has no cash, no assets, you may write to HMRC to tell them of your intention to strike a company off. Striking a company off is filing a DSO1 form at Companies House. Now, there is a period of around 60 days where creditors can object to the strike-off. And if it's not been objected to, so let's say you file your DSO1 form, and if you've got a bounce back loan, the bank will definitely object to it. You cannot strike a company off with a bounce back loan. But if no one objects to your strike-off application, it is dissolved in around 90 days' time. Okay? Another question I get asked is, how long will the process of liquidation actually take once you're in liquidation? And that's a bit like, how long is a piece of string? It depends on the complexity of the liquidation. Some can take years and years, but most small insolvencies, the insolvency practitioner wants it closed in 12 to 18 months' time. And that's where you'll go on company's house, you go into, when you're in liquidation, it says in liquidation next to your company on company's house. And then when the liquidation is concluded and it's finalised, it will say dissolved. That can take 12 to 18 months. Okay. Here is another question that we get asked regularly. I hope you can notice that the handwriting is very neat. It's not been done by me, it's been done by Atch. So thanks for that, Atch. So, can I be a director again? Okay. So there is a myth that when you put a business through an insolvency process, you will automatically be barred and disqualified from being a director. That is a myth, because for the majority of directors who place their business through an insolvency process, they will not be disqualified and they will be free to be a director of another company again. There are some exceptions, okay? We're seeing a lot of disqualifications at the moment from bounce back loan fraud. That is for business owners who took bounce back loans when they shouldn't have taken them, if they've increased their turnover to get a bounce back loan. Obviously remember, you could only project turnover if you was incorporated after the 1st of January 2019. If you was incorporated previously, you had to apply for 25% of 2019's turnover, capped at 50 grand. So for those that inflated their turnover, or those that took a bounce back loan and shouldn't have took one, for instance, they took one when their company was dormant, and then you go for an insolvency process, it's highly likely you're going to get disqualified for your actions. Not 100%, but highly likely. Disqualifications above and beyond bounce back loan and sort of coronavirus funding abuse, they are there for the most serious of cases. So where directors have gone out there and continued to take customer deposits, knowing they're never ever going to actually fulfill the job, that's likely to end in a disqualification. If you have, misappropriated all company funds and you've spent it for personal gain, that's likely to land you with a disqualification. But for the vast majority of inquiries that we receive here at Director First, the director does not get disqualified. Again, this is just general terms. We'd need to hear a little bit more about the specifics of your situation if you're worried about a disqualification. Here is the biggie. I've saved the biggest for last. Will I be made personally liable for company debts? So, let's talk about the facts. A limited company gives you limited protection. You are not the company. Chris Worden Limited is a legal entity separate from Chris Worden. And in an insolvency process, the idea is that limited liability protects the director and they are not made personally liable for company debts. There are some exceptions. One of the most obvious ones is personal guarantees. So if you've signed a personal guarantee for a company debt and your company ends up in an insolvency process, the personal guarantee is going to crystallise and they're going to come to you for the money. Now, you will have options to either pay it all back. Most directors can't. Most PGs will allow you to restructure them over a longer period of time, and in some cases, if you can raise a lump of money, some PGs will accept a full and final settlement off you. Okay? Again, if you have worries about PGs, drop your details in the assessment below and we'll get one of our team to talk to you and talk you through how it might work. But yeah, personal guarantees is where you can be made personally liable. Bounce back loan fraud is another area where people are being made personally liable for business debts, specifically the bounce back loan. So if you've taken a bounce back loan when you shouldn't have taken one, like you was a dormant company, shouldn't have took a bounce back loan, or you was subject to insolvency proceedings, or you've took more than one bounce back loan in one company, or you inflated your turnover. That is where you could be made liable by the insolvency practitioner or the insolvency service for that bounce back loan. Okay. Another area where people are in a roundabout way made liable for company debts is where they have overdrawn directors' loan accounts. And this is like a ledger between the director and the company, where every time you take money out of the company that is not salary, okay, it's recorded on your director's loan account. Every time you put money back in, it's recorded as a credit on your director's loan account. When a business has become insolvent, so it can't afford to pay its debts when they fall due, liabilities are more than the assets, the business is no longer profitable, therefore the director cannot take dividends. Because directors don't realise they're insolvent until too late, they have already taken dividends for some time, or in their head the dividends, they're actually drawings. They only become dividends once your accountant declares a profit, okay? So lots of directors out there end up with overdrawn directors' loan accounts when they go through an insolvency process. So even if they've took the right amount and they've never had a director's loan years previously, that final year of trading where they've become insolvent, but they've still continued to take drawings above and beyond their salary, means that them drawings above and beyond their salary that they think is a dividend is going to be reclassified into an overdrawn loan account. And that, I've got an itchy nose. And that is when an insolvency practitioner is going to ask you to repay the money back into the insolvency practitioner's client account. Now, it's highly likely that lots of directors who have done this knowingly or unknowingly, they've not got the money to pay back the insolvency practitioner, but they are going to try and make you personally liable for that amount of money. In most cases, deals can be done. And the deal justification needs to be, is the deal that you're offering to pay them, and that can be a lump sum settlement or a reduced settlement over a period of time, is that a better realisation for that insolvency practitioner than making a director bankrupt? Now, bankruptcy scares the life out of most people. But the reality is when you're making somebody bankrupt, it takes a lot of time and it costs a lot of money. And that presents a lot of risk to the insolvency practitioner. So most of them will accept a settlement. My advice to you, or if you're new to the channel, this is dead important. I want you, before you make any decisions on insolvency and who you're going to use, you need to get really clear on your director's loan account, because this is the thing that is going to bite you on the arse, and it's going to hurt, and it's going to hurt a lot more if you've got stuff to protect. If you're watching this video with a property with lots of equity in, or you're mortgage free and you've got a director's loan account, this is going to cripple you, because if you've got lots of equity, it's arguable that you can pay it all back. So it's important to understand what your position is on a director's loan account. If you've got up-to-date management software, run a trial balance. It will tell you where the loan account sits. If you haven't got that, sadly, you might have to go back to your last set of accounts. And in the asset section or the data section or the director's advance section, it will tell you if you have an overdrawn loan account and whether it's in credit or debit. Sadly, if you go into your accounts to find this out, the reality is that position's changed. And this is why it's so important to have monthly management accounts, in my view. If you're relying on your accounts, it's a snapshot of your business at a day in time. And if you've continued to take money out of that business since those last set of accounts that is not through salary, and your business has been insolvent for some time, your director's loan account has gone up. So once you understand this, and by the way, we'll help you with this. If you are worried about director's loans, click the assessment below. We'll get one of our team to call you today. And what we'll do is we'll help you understand your position up front. We don't want any money for it, okay? We will help you understand what your position is, and we'll work with some of the insolvency practitioners that we work with to get some type of deal done. Deals can't be done in all circumstances. If you've got £1 million mortgage, £1 million house with no mortgage and loads of savings, you are going to be asked to pay most of it back, if not all of it back. But sometimes we can get you some extended terms, okay? The key thing is at the moment, you may have some ability to negotiate before you make the appointment. Now, there's a caveat here. An insolvency practitioner cannot formally accept any type of negotiated settlement until they've been appointed. While they've not been appointed, they've not actually got the authority to do this. But most good firms will have a conversation with you up front. We certainly will do here. So, and this is the biggie. Why should I trust you lot, director, first? So, I'm going to tell you why. First of all, our whole business model is aimed at advising you, the director. I've been through where you've been through. I had to place a business through insolvency many, many years ago, and I realised there was very little director-focused advice out there. A lot of the advice I found confusing. I went to visit insolvency firms, and my experience was really poor. I felt very, very, I was spoken down to. I was treated like a criminal. Nobody would give me a clear answer. People were mainly focused about getting money off me, and then they talked to me. It was a real painful process. And adding to the fact my mental health at the time was in the toilet, you know, my business was going down. I didn't know how I was going to feed my family. It was a terrible experience. And on the back of that, I thought, you know, maybe there's a better way. And I teamed up with a guy who'd been doing this for years, and we went out there and we started to educate directors about insolvency. And the model today is really simple. We will give you a ton of free advice on what your options are and what the problems are going to be for you personally as a result of the insolvency. That's not to say insolvency can be avoided, because in a lot of cases it can't be. What I believe is you should be well informed on day one about the problems that are going to come down the line. And I work with 7 licensed insolvency practitioners. So I speak with them, we get them on the calls. Everything is thought out with between me and you and my team about how you're going to deal with this before you make a decision. Now, if that's not enough for you, I want you to go and check our Trustpilot. We've got close to 600 reviews. And if you factor in my old company's reviews before I left them, I've probably got close to 1,000. No one's got anywhere near them. And it's not just Mr. Chris was very good. We have heartfelt reviews about directors exactly like you who have been through this process, and we've supported them to strength. We've held the hand, we've answered the questions, and we're not that firm that takes your money and doesn't answer the phone again. We are here for you throughout the process. And for the really brave directors, I've interviewed quite a few of them. So go and have a look at the interview section on the channel as well. And that is real life people sharing their experience of working with Director First. But guess what? Don't take my word for it. Go and speak to another few firms. You've got to go what's right with you. Just make sure you're speaking to a firm that's discussing everything with you up front. So I hope you found the video useful. If you want to go and have a look now at the next video that's going to tell you all about overdrawn directors' loan accounts, I want you to go and have a look at it. It's going to be up there. It's going to tell you everything you need to know about overdrawn directors' loan accounts, what they are, if you've got one, and if you've got one, what you're going to deal with, what you're going to do about it. Chris Worden, Director First. Thank you.